We will now begin the conference call, and for that, I would like to introduce our CEO, John Bird.
Thanks, David, and thank all of you who have chosen to join us this evening. We're trying this out as our customary time tends to be in the morning, and we know that many of you have other obligations during the working hours. So please let us know if this time is more effective for you, because certainly we want to offer our thoughts at a time when most of you can participate. Those of you who know us know that we really work quite hard to offer a combination of rigorous investment analysis and portfolio design, along with individualized financial advising work. We really want to help our clients get on and stay on track toward their goals, whatever they may be. This combination must resonate with folks because we do continue to find our services in demand, and for that we thank all of you. We couldn't exist without you. My role and goal is to allow us to meet that demand for our clients while remaining true to our collaborative and cooperative client-centered culture. We work really hard to make sure that we never lose focus of who the boss is, and it's those of you who are participating in this call who really guide us in why we do what we do. And thank you for those of you who have referred your friends and family to us. It does help us, and it also validates what we're doing, because we certainly like to know if we are on the right track. This evening, as David pointed out, we have three panelists. We have me, John Bird, co-founder and chief executive officer of Albion. We also have Danny Gregory, who's one of our senior wealth advisors and has a wealth of experience in helping our clients work through a variety of issues. And of course, Jason Ware. Those of you who have been on these calls are familiar with Jason and his insights that he brings as Chief Investment Officer to Albion. As David highlighted, if you have questions, please do submit them. And note that we're going to be general in our responses. It's not really the forum for us to address any specific issues that regard any one of our client families. We do want to address those issues and encourage you to reach out to us directly during our working hours to make sure that we can address your specific concerns, challenges, or opportunities. With that, we'll get going. And what I'd like to do is begin by focusing on the thing that tends to be on most of our minds, which is what is happening in the economic world. Now, how is the economy looking right now in a general sense? And so I'm going to pose the question to our panelists and put it out there that how is the economy looking right now? And Jason, would you like to pick up on that?
Sure. Yeah, happy to jump in, and thanks everyone for joining us this evening. So I'll just start really high level. We're 4 years into a post-COVID recovery. And the U.S. economic expansion keeps chugging along. It's ignoring several notable people like CEO of JP Morgan, Jamie Dimon, and many conventional recession indicators that long ago suggested a slump was imminent. So the economy continues to be pretty resilient. We've seen things like a massive inflation surge and a resultant Fed hiking cycle, an inverted yield curve, persistently negative money supply growth, a chronic decline in LEI, weak residential building permits, an unemployment rate that's been at or under 4% for about 30 months. These have all been false signals so far as it pertains to kind of predicting recession. Those things have suggested that recession is imminent, and yet we've avoided recession. And what's becoming clear to us is that this cycle has been very much impacted by the incredible boost in fiscal spending that's occurred since COVID. We spent trillions of dollars and we're still running deficits right now at about 6% of GDP with low unemployment. So this type of pro-growth fiscal policy, keeping the economy going at all costs, if you will, has been a powerful force on the economy, and it's allowed us to avoid recession despite periods of slowing, despite some of those worrying leading indicators, despite the predictions from the big Wall Street banks. It's kind of been an odd cycle, and you've heard us talk about that a bit in the past. It's just kind of been weird post-pandemic. The Fed seemingly won't end its tightening campaign. And despite the economy being pretty durable, having that durable expansion, both consumer and business confidence have been at recession-like levels. They've been stuck at pretty low levels for some time. Some of you even coined this, they called it a vibe session. So there's been a lot going on, a lot of cross currents, a lot of confusion happening. But that said, we are seeing clear signs of economic slowing at this point, most fundamentally in the labor market and with consumer spending.
It feels like certainly those of us who purchase things, which is everybody, inflation has had an impact. We are experiencing higher prices, although what we have felt is that the growth in those prices has moderated significantly from that inflation peak you referenced, Jason, a year and a half ago. What is your view? What is the Albion line on inflation right now?
Yeah, great question. Certainly forefront on most folks' minds. And look, we had a bumpy start to the year with regards to the disinflation process that's been underway for almost 2 years. And disinflation, of course, is a lessening of inflation's rate of change or the growth rate of inflation. That appears to be getting back on track now. Specifically, the most recent CPI and PCE reports, which are key gauges of inflation, have been pretty encouraging. Inflation can be tricky because there are a variety of ways to skin the inflation cat, and most of them are, at this point, the good news is most of them are showing that things are trending back to better levels. PCE in particular, which is the Fed's preferred measure, it's our preferred measure as we look at inflation.
Can
It's
you
been under
define that, Jason? Define PCE.
Yeah, it's the consumption expenditures index that the Fed looks at. Personal consumption expenditures, what it's called.
Okay.
It's
Thank
released
you.
from the Bureau of Economic Analysis. Yeah, so basically PCE is preferred over CPI because PCE takes into account things like substitution effect. If you're at the grocery store and pork is less expensive than beef, consumers make choices in real time. So it demonstrates that consumer choice. It's also broader than CPI. The baskets aren't as extreme in terms of like shelter, for example, and healthcare. So it's a preferred measure from the Fed, and that has been under 3% on a year-over-year basis all year. It's been sub 3% for some time. When you look at things like median and trimmed mean CPI, which attempt to strip out the extremes, like we've seen auto insurance going up, shelter costs have been sticky, they're coming down, but they're still impacting inflation quite notably. These things are all sitting down around 2%. The 3-month moving average for some of these measures are in this zone as well. And as a reminder, the Fed's target is 2%. So we're kind of getting in the zone here. But even in the face of all of this improvement, inflation, as you noted, John, and I completely agree, remains top of mind for many. One, because we've all dealt with it so recently, making the pain of it still kind of fresh. And then second, there's that important distinction. We've talked about this on a couple of conference calls in the past, the distinction between price level, that's the inflation people feel, and the rate of change of inflation, and that's the inflation that markets and policymakers focus on. And the latter is reassuring, right? We're talking about how that's disinflating and coming down. But the former still has people not feeling so great because general prices are up about 25% versus pre-pandemic levels. So just to kind of wrap it up, inflation's moving in the right direction. Going forward, and this has been our call for some time, we expect the rate of inflation to continue to fade, though we do consider inflation's floor and this time around to probably be higher for the balance of this decade versus that of the 2010s when the Fed couldn't get to their 2% target no matter how hard they try. So we kind of think about inflation as a 2% plus kind of situation as opposed to 2% minus.
Right. And that is so consistent with the data and the information that we've been seeing with regard to where inflation is and where it is likely to go given the pressures we see on it. Jobs, you just mentioned jobs in your last comments, Jason. We hear same mixed messages. Consumers feel uncomfortable, and then there's certainly talk that, gosh, are the jobs out there? How does that sensibility that many of us feel, not all of us, how does that compare to what the data shows us?
Yep. So, job gains have slowed. We're seeing a normalization of the labor market. This has been underway for some time. Wage growth has come down. Layoffs have drifted up. Things like long-term unemployment are higher. Job openings have come down. We've seen that consistently in what's called the JOLTS data. Employee-driven turnover is back to normal. That's known as the quits rate. And business hiring plans have largely eased over the past several months. So the official employment rate, which is known as U3, is up about 0.7% off the bottom, which is still low. I want to be very clear. It's low, but it's moving in the wrong direction. So historically, what history teaches us is that once unemployment gets going, it often keeps going to undesirable levels. Moreover, we know that wages follow unemployment with a small lag. So if this rising unemployment trend that we've seen, again, off of that 3.4% low up to 4.1% right now, if that trend persists, then we would expect income growth to continue softening as well. And there's obviously nothing more important than wage growth when it comes to consumer spending. And consumer spending, of course, underpins general economic activity. So the jobs picture is something that bears watching. Now, I want to be clear, like we wouldn't say that things in the labor market have rolled over completely, but they have normalized, and as we've said, they would for months. So at this point, really the important question, this is what the Fed's looking at as well, is will the labor market slow in this sort of perfect, like immaculate fashion, or will it overshoot to the downside, going too far and cause a recession? And this is essentially the central question underpinning the soft landing scenario that everyone, including the Fed, hopes that we get. So the data is softening, things are slowing, but the question is it healthy normalization, or will it be something a little more menacing? And we'll see.
And I think it's important to just for clarity highlight that while we are seeing wage growth slow, there is still wage growth. It's just the rate of growth has diminished. And so
Right.
that certainly is a positive.
And just to put a number on that, the most recent jobs report, wages were up 3.9% year over year. They were up north of 6% at the cycle high, which of course was, according to the Fed, and I think most economists, was too high of a rate in terms of like it's feeding into inflation. So seeing that come back down is something that investors celebrate, even if we all want to see, strong wage growth.
We touched briefly on interest rates, bond yields, inverted yield curves. As you highlighted, it's been an unusual period where we've been on the potentially 6 months away from a recession for about 3.5 years.
Right.
And have never closed that gap, which that's great. Although recessions are a normal part of the business cycle, it's okay to have recessions. But as we touch on interest rates and bond yields, we've seen them climb dramatically along with inflation. We've seen them come off. I think we're back at a 4 handle instead of a 5 handle on most bond portfolios or new bond portfolios in the treasury yield curve. What's our perspective there, Jason?
Yep. So another great question, and kind of the best way to answer the question is to start by deconstructing what part of the yield curve we're talking about. This can get complicated really quick. So for just the sake of simplicity, we separate it out into short-term and long-term buckets. On the short end, treasury bills and other short instruments like money market funds are still paying higher yields than their longer-term counterparts. For instance, right now, as you noted, John, the 3-month T-bill as of the close today was yielding just over 5.3%, while the 10-year treasury bond is just under 4.2%. And that's what's known as the inverted yield curve. And it's an abnormal situation. So yields at the short end will follow very closely what the Federal Reserve does with interest rates. And we know, of course, from March of 22 up through July of last year, Jerome Powell raised rates aggressively. And so yields here on the short end went up by a lot. And when they cut, and they eventually will cut, yields here will fall. Now, how far they fall will depend on largely kind of where the floor is for the federal funds rate. And just to give you a window into our thinking there, save for like a nasty economic shock to the downside, the lower bound on the Fed's fund rate is probably somewhere around 3 to 3.5%, or 2% lower than where it stands today. It's unlikely to be zero, which is where it was for 15 years after the 2008 financial crisis. And that's an important difference in this cycle, potentially impacting a variety of things. So that's on the short end. We're going to see short rates, bills, money market funds, et cetera, cash-like instruments follow the path of monetary policy. Longer-term bonds are far more than Fed policy. Short rates set the foundation, but long bonds are also priced primarily off of things like economic growth and inflation. And so the basic math to arrive at how we look at yields, what our yield outlook is, as we're kind of adding up the pluses and minuses. So for example, for the 10-year treasury bond would be to take your assumptions on a normalized neutral Fed funds rate. Again, in our case, it's like 3.5%, which is essentially inflation plus some level of real interest, or what economists call R star, if you want to get really wonky, but we won't go there. And then you add a term premium, which historically has been around 1.25%. So when you combine all of that out, we think a 10-year bond somewhere in the 4.5-ish% range, which is not too far from where we stand today, seems reasonable. And so to kind of put a conclusion on it, it sort of feels like long bonds are appropriately priced for the macro fundamentals that we see, unless we're way off on our inflation or economic growth assumptions. And so most of the action in the fixed income market will probably be on the short end as the Fed adjusts rates. So that's how we're thinking about yields and rates in the context of the current environment.
Well, and you highlighted an important point that since the 2008 financial crisis, we got used to interest rates being close to zero, which across the span of economic history is not normal.
Unusual,
And
yep.
to have the rates, certainly with a 4.5-ish 10-year treasury, is a whole lot more in the range of what one might expect as a sustainable rate than the rates that we experienced during that decade of the tens.
Yeah. Yeah, we've called it, internally kind of the restoration of the laws of financial physics, right? Zero interest rates or negative interest rates are abnormal and they can distort financial markets. Getting back to a positive real yield environment is healthy, and equities can do, and the economy can do just fine under that construct. So that's largely how we see things unfolding in the years ahead.
When we talk about short rates, of course, the Fed Policy Board has a huge influence on that. What's our expectation with regard to what the Fed is likely to do, and how might that impact markets? What's priced in, what's not?
Yeah, the Fed parlor game is not too far from markets' minds at any given moment, and certainly given the aggressive hiking cycle, we've seen everyone's kind of wondering, like, when are we going to get that cut? And look, it's been 12 months since the Fed stopped raising rates, and historically speaking, in the world of monetary policy, that's a pretty long plateau, 12 months. So, as I mentioned in the last response, we will eventually get a rate cut. It's unlikely to occur at the Fed's July meeting in 2 weeks, but it's looking increasingly likely to happen at the September meeting. So then we have to ask ourselves why. Well, as noted, after kind of a bumpy start to the year for the inflation data, and of course the Fed is laser focused on inflation and has been for a couple of years, that disinflation process, that lessening of the inflation's rate of change or the growth rate of inflation appears to be back on track, as we discussed. Nevertheless, Powell has repeatedly said that he wants to see more evidence that inflation is firmly under control before gaining the confidence. And that's a word he's used a lot lately in press conferences and talks that he's given and in fireside chats. Confidence. He wants to be confident that inflation is under control before they begin cutting. And the way that things are trending lately regarding inflation and jobs, both front and center for the Fed, part of the Humphrey Hopkins 1978 dual mandate, it seems that they are getting close to achieving that confidence, i.e. inflation's coming down to where they feel good about it. And by the way, the labor market's loosening, so they don't want to see that kind of get out of hand. So our best guess is that we're at the point where they're going to begin to start easing, probably in September, but if not September, we would expect at the November policy meeting, which I think is the 6th and 7th. So it's coming soon.
Right. I find myself in an interesting position here because I'm asking the questions which I am more accustomed to answering, but I really like your answers, Jason. They're excellent. So it's a fascinating role to be in on this conference call. I'm enjoying it. So I will pose the next one. How are we thinking about the upcoming election and the impact it may have on the economy, markets, and ultimately our investment portfolios?
So this is always our favorite question, right? And I say that in jest, of course. Elections are something that we all pay attention to. They can be frustrating. They can drive us crazy. They can be, certainly a whipsaw of emotions. But as it pertains to markets, our view is, and this is consistent with this year and in 2020 and 16, you can go far back and see our thinking on elections. The outcome in November is probably a non-event as it pertains to markets. I mean, there's no doubt that there are substantial differences between President Biden and candidate Trump across a variety of things at the sector level, across healthcare policy and energy and banking is just some examples, as well as in macro policy terms, think taxes, regulation, trade, immigration. There are definitely some differences. But as it relates to this notion, this is what's usually thrown around when folks talk about markets and elections, this notion that one of these guys elected is bad for stocks while the other one is somehow good. That's not really how we think about it. Both history and just quite simply the reality of politics and markets suggests that we should take a more sober and objective view on this question. So as we look at the data, and of course we like to go back to the data to keep us on the right track as we're thinking about this stuff. In all election years going back to 1950, the S&P has typically delivered a high single-digit type of return in election years. I mean, sure, that's a bit below the annual long-run average for stocks, but it's directionally positive, and it's certainly an acceptable outcome. And so far this year, we're tracking better than that. The S&P is up more than high single digits. So that said, we kind of do expect some volatility ahead as we get closer to the election. Now, kind of digging down a little bit deeper, I think it's reasonable to think that a Biden, and this ties in economics a bit, it's reasonable to think that a Biden reelection would be perhaps less inflationary than a Trump redux, because Trump's policies around tariffs, which are more severe, deglobalization, which is kind of pushing for more reshoring and other more isolationist policies, immigration, which effectively reduces labor supply and thus kind of pushes wages up, which can be inflationary, as we talked about. All of those things juxtaposed with lower tax rates and less regulation, which can kind of boost aggregate demand and investment. Those things are inherently more inflationary than would be the case otherwise. So that's one way to think about the potential impact. I mean, there's a long string between now and when the election hits, and then when president's inaugurated, and then those policies being implemented. So we have some time to kind of figure out how that looks. But that's one way that we're thinking about it.
Well, and I think if we end up with a reignition of inflation at some level, the key is, will the companies that we own be able to raise their prices in line with inflation to keep our investments intact? And certainly history suggests that yes, they can.
Right.
That
when you own, when you own great companies with wide moats and good management teams, they can handle the inflationary environment. And I think it's worth mentioning, John, that just as important, everyone focuses on the presidential election. Just as important, if not more important, at least as it pertains to markets, is what happens with Congress. And that usually gets lost in the discussion. Are we talking about a Republican sweep in November? Is it going to be more mixed arrangement, which is to say gridlock, markets like gridlock? That's the kind of political math that's really going to matter in terms of what does and doesn't get done in Washington over the next 4 years. So as you take all of this and kind of distill it down into what does this mean for investments and for my money, if you're listening to this and like, okay, Albion's managing my money, what does this mean for my portfolio? We think, and this is a very consistent line for us, we think it's best practice to avoid mixing politics and portfolios. Instead, we want, and this goes to what you were saying, John, instead we want to focus on the operating fundamentals and the earnings power of the companies we own on your behalf, your investments, as well as the price we're paying to own those assets. And we think if you get those two things right, the fundamentals and the valuation, and then of course control our feelings and our behavior, that's 90% of the ballgame. And admittedly, in an election year, controlling our emotions is difficult because emotions are running high, but that's the work that we do as objective wealth managers.
When we look at the last year or so, the S&P's had a pretty strong run. And if you take out 7 companies, it's not been quite as good. And if you remove one company, NVIDIA, it knocks quite a bit off the total return of the S&P.
Yep.
What's going on?
Yep. So the environment at the index level, the backdrop at the index level is pretty good. I mean, as we talked about, we have an economy that's growing, but it's not too hot. Within that, we have positive job growth and wages are beating inflation that's coming down. Household consumption is still rising. Consumer spending looks okay. Corporate profits are up. The outlook for corporate profits are pretty favorable. The Fed's getting close to cutting. There's a lot of enthusiasm, animal spirits even, around tech and AI that are driving markets, and that has the potential to accelerate productivity. So there's a lot of good things happening. There's this elixir that's happening as a backdrop that's helped the index level, the S&P 500, the NASDAQ, as you mentioned. But when you drill below the index level and you get under the surface of those indices, there's some interesting things going on. We've seen a lot more churn. We've seen considerable volatility. And as you noted, less impressive returns. So for instance, the average stock in the S&P 500 is up about half as much as the index itself this year, so far, year to date. The percentage of stocks that are outperforming the index itself is at record lows. About 20% of the constituents of the S&P are outperforming the S&P's top line number. Historically, that's 45, 50%, and we're sitting at 20%. If you look at the drawdowns this year, we saw the S&P fall 5% in April. NASDAQ was down, I think, 7% in April. But the average member in those indices saw corrections of 17 and 40% respectively. So there's this huge concentration in the market where everyone's crowding into the mega cap tech winners and NVIDIA with regards to AI. And because of the simple math of market cap weighted index like the S&P, that's driven the returns, while there's 493 other companies in the index that haven't done quite as well within the context of higher interest rates and inflation and just some of the macro challenges. So, no doubt about it, a lot of concentration in the market. These are great companies, so I don't want to take anything away from what they're doing. They're contributing 25% of the profits to the index. But yeah, there's it's been a narrow market, to be sure. It's been a skinny bull, as we've called it.
Skinny bull.
Yeah.
Don't see those driving through Montana. Danny, I'm going to pivot over to you. We have an election year. What should we be thinking with regard to changing our financial plan, adjustments to our financial plan, or do we largely ignore that in our financial planning?
So kind of in the same line of what Jason was talking about with our portfolios, the way we look at it is there really isn't much that we recommend. There really isn't anything that we recommend adjusting with your financial plan right now. And really things that can be affected, like what Jason was mentioning, is doesn't really matter what president is in office. It's what happens with Congress and what laws does Congress pass? Like, do they change tax laws? What happens in that sort of case? And those are things that can change your financial plan. Right now, we don't know what will happen. And when that does happen, that's when we will change your plan. So the way we really looking at financial planning is it's dynamic. It is constantly changing. That is why we want to consistently be meeting with all of our clients, because what we do right now might be different the next time we meet because these tax laws and what's going on changes, but there isn't anything that we would really change right this second because we don't really have anything that's changed.
That makes a lot of sense. When we think over the last number of years, we've had a couple of changes that have impacted planning. One was the ability to do charitable gifting directly out of your IRA, and it counts toward your required minimum distribution. Another is the increase in the age at which required minimum distributions must begin. So things do change, and we just have to track what Congress is doing and what laws actually come through, what bills are passed, and then how those are implemented, what the regulations around them are, and need to, at that time, we reach out to you. In that light, we do have a tax law that sunsets in 2026, which it's amazing how you blink and that will be here. Are there any things we should be thinking about with regard to the sunsetting 2026 tax law?
Yeah, so you are referring to the Tax Cut and Jobs Act that happened in 2017. There are a couple of things that happened that will sunset. So the first thing, marginal tax rates will go up. The highest tax rate will go from 37% to 39.6%. So that's something to be aware of. Standard deduction, the big thing, if you all remember, it doubled. So I don't know if you guys remember back, a lot of us probably we talked to you clients of, how do we maximize your itemized deductions in certain years because the standard deduction became so high that you stopped itemizing deductions. Well, that will revert back. So itemizing deductions will become popular again because the standard deduction will become lower. The SALT deduction, so that is like mortgage interest, state taxes, those sort of deductions, they have been capped at $10,000 a year. That will go away. So again, there will be more things that you can itemize. Mortgage interest deduction, that limitation there, that cap will increase back up. There's different things like if you have a pass-through entity, the QBI deduction, the 20% QBI deduction could go away. And then the big thing that I think really I am emphasizing clients talk to is review your estate planning. I always say, in general, you should be consistently reviewing your trusts, wills, how that's structured, just because your wishes change. But tax laws are constantly changing, and this is a case where tax laws may change. So a big thing that will happen if these tax laws sunset is that the lifetime exclusion and the gift tax exclusion will decrease. So what that means is right now, if you pass away with an estate that's under around $14 million, you don't have to worry about estate tax. And that's for one person. So if it's two people, $28 million. Well, most people don't have to worry about estate tax right now. When the that tax law sunsets, that's going to be cut in half. So then a lot more people are going to have to start worrying about estate taxes. And so that's when really good estate planning starts to kick in, and where you want to like kind of revisit that with estate planning attorneys. And so we can kind of talk to you about that, talk to you whether that kind of applies to you, if we think, you know, you're there or you're going to get there, you know, you're on that path to where that situation is going to apply to you, and advise you in that direction and work with your estate planning attorneys.
Thank you. That's you have a wealth of knowledge and
Sorry, that was a
at your
lot.
fingertips with regard to the various tax codes. That's beautiful. How about Social Security? We hear a lot of doom and gloom about will it be there for us? How
Yeah.
should we think of Social Security as we're doing our own planning? And what adjustments, if any, should we make to what we currently see on our Social Security statements with regard to anticipated benefits?
So I think the last statistic I saw, the OASDI trust fund, so kind of where the Social Security payments are paid out of, is going to be depleted in 2035. Now that's scary sounding. That's really scary sounding. Okay, does that mean Social Security just goes away in 2035? No, it does not, because there's people that are still paying into Social Security. It just means that what's being paid into Social Security is probably going to be immediately paid out. Do we think Social Security is going away? No. Social Security is very, very popular. This country does like Social Security. I think if you talk to anyone in retirement, they enjoy having their Social Security payments. And so I think from a political standpoint, you know, Congress is going to do something to keep Social Security going forward. And they have a couple of different levers to do that. I think one of the two most probable things, if not both, that will happen is either they're going to start taxing more of Social Security benefits. So right now, depending on your income, either none of your Social Security is taxed, 50% of your Social Security is taxed, or 85% of your Social Security is taxed. I could see them start taxing all of your Social Security as ordinary income. And that's just getting more money that then they can pay out as Social Security benefits. The other thing that I think could be very probable is that they're just going to keep increasing the age that you start Social Security. So for example, I'm 36. I'm not counting on Social Security till I'm in my 70s. I do not think that I'm gonna get full Social Security retirement at 67. That's not happening for me. So the further that they push that out, the longer time period that they're going to have to pay out a benefit, especially since people are living longer. I definitely think that's going to happen. So those are kind of, I think, the two big things that are going to happen. I don't know, John, if you think.
Yeah, I think those are both valid. I think on the revenue side, you could also either increase the payroll tax,
Yeah,
or subject more income to payroll tax. It raised the threshold at which Social Security tax is due for personal income. And Social Security is relatively easy because there are just a handful of levers, and you have to decide which ones you're going to use. Is it going to be on the benefit side? Is it going to be on the revenue side? And which levers do you use? So it is resolvable if we decide we want to resolve it.
And it's worth noting that we've fixed it before. Back in, I think it was 1983, under Reagan, we faced a similar problem, and they made some of these adjustments that you guys are talking about. And John, on the payroll tax, I completely agree. I've seen some analyses that have shown if you just raise that by 1% from like 12.4 to 13.4, roughly where it sits now, that would solve about 25% of the shortfall. So there are ways to correct it. That's the good news, and we do think that eventually they're going to have to do that.
And I will say, and this probably doesn't, I mean, our clients, the people that are listening to the call, are not, you guys are all saving and you are investing and you're doing all those things for retirement. But I do like to always just say, let's not rely solely on Social Security, because it is going to be there. But I mean, it's just such a small piece of what your retirement is that there's just so much more to retirement, that there's so much more we need to focus on. But it is an important piece.
Right. Well, thank you. Another thing we've seen, and we've worked with some clients through this, Danny, is someone either is retiring and they want to move, be closer to their children, they want to downsize, they want to change their house to something else. And it is often a significant asset on their balance sheet, and there may be a mortgage attached to it with an interest rate that's far lower than anything that they could get today. How should we think through that?
So again, with all things that are financial planning, it's very, very personal and is going to be very individualized. But the way I kind of look at it is, what are the pros and cons? So why are you moving? Are you older and downsizing and you just, you just can't manage your household anymore? Are you going to be getting rid of a mortgage? Are you wanting to be closer to your kids? What does that look like and why are you doing it? Because I think the first reason is, like, if you're going to do it and that's important to you, then there's a push to figure out how to do it. Now, the underlying thing is interest rates right now. If you have to get a mortgage, they're just under around 7%. Now, do we think they're going to get back down to 3-4%? No. In the next couple of years, they're going to go down, but we'll probably even out somewhere in the low 6, mid 5. And Jason, you can correct me on that. Maybe a little lower, but the years of high 2%, low 3%, they're gone. It's probably not going to happen again. At least in not like the next 10, 15 years. So I think having that mindset of I'm going to wait for something like that to happen again is just not going to happen. So if you want to make some sort of move, then making that adjustment now makes sense. I think I just always like to go back to like the basic principles of, if you're moving, buying a house, okay, does it make sense cash flow wise? So always having enough to put 20% down. What does that look like? Okay, so if I'm moving to be closer to my kids, my house costs $1 million now. I have a $300,000 mortgage. I'm going to have to buy $1 million house there. It's the same house. I'm going to have a $300,000 mortgage. Well, now my mortgage payment is X dollars more. Can I afford it? What does my cash flow look like? Is that still, we kind of recommend, okay, don't have your mortgage payment be more than 28 to 30% of your income. Does that then increase that? Does that move, that's a very lateral move, make sense? Like, is it worth it to then be spending more on this house? And so just thinking through, and if it's to be closer to your kids, like John originally said, then yeah, that could be worth it. That's a reason for it to be worth it. And so it's just really, really individualized. But I just want to bring back of like the interest rates. We're not going to get back to where we were. So I think there has been a lot of, let's sit and wait. And I do think interest rates are gonna go down, but they're not going to go down as much as we want them to. And so I think you shouldn't put your life on hold, But again, it just doesn't make sense for you and your situation.
And if I may, I'll build on that a little bit with some color on how we're thinking about mortgage rates. I would agree, Danny, with the general idea that rates can come down. The 30-year mortgage rate can come down, but it probably has limits to how far it's going to come down. Going back to 3%, 3.5%, 4% seems unlikely. Here's why. Recall the discussion we had around kind of our view for what would be a fundamentally reasonable, like 10-year treasury bond. Well, the 30-year mortgage is priced relative, in just simple terms, just a way to think about it in simple terms, is priced relative to the 10-year bond. It's not priced relative to the short end of the yield curve. Rather, if you look at historically the relationship between the 10-year bond and the 30-year mortgage, there's usually, and I might be a little bit off on this number, but if memory serves, the spread there's usually around 125 to 150 basis points, or 1.25% to 1.5%. So if our view on the 10-year, structurally speaking, is somewhere around 4.5%, and then you put a 1.5-ish% premium on a 30-year mortgage, you're talking about high fives, low sixes. Now, to be clear, there can be periods, because that's kind of a structural view, like what makes sense in terms of, like perfect economics. And of course, we know the world isn't perfect, the world's messy. If we have a situation evolve where we have a left tail risk and we have a downside shock to the economy, whether it's a recession or another pandemic, God forbid, but something like that were to come out of nowhere and hit us, the Fed could certainly lower interest rates below that floor that we see makes sense, at 3 to 3.5%. So if the Fed were to take rates quickly lower to try to stem some type of crisis, and they did that for a short period of time, not structurally ZERP forever again, but they took it down for a while, we would see the 10-year bond and 30-year mortgages come down as well. But that would be probably pretty short-lived, and you'd have to be very nimble to capture that. So again, kind of echoing what you're saying, structurally, 5.5% to 6% seems fair for a 30-year mortgage.
And in that case, and that's when we did this in the past, that's when we would look at, does refinancing make sense? Like, can we take advantage of, does a lower interest rate make sense? And it depends. And that will depend on each person too, and how far you are into your loan and all those sorts of things. But those are the numbers that we can run for you.
Great point.
Right. Well, thank you. I don't think I'm going to move anytime soon. I'll just stay right here. We did have one question from one of our attendees, and that was really about, how do I think about asset allocation in my public market assets, stocks and bonds, as I enter retirement? And I'm actually going to take the first shot at that, because the only real clear answer is it depends. It depends on your income need from the portfolio. It depends on your comfort with volatility in the portfolio. And it depends on the duration of the portfolio, how long you expect to live. So how much of the investments need to be positioned to give you a great possibility of outpacing inflation over the years of your retirement. So it's a big, it depends on your specific situation. The kinds of tools that would be in there would be generally super safe assets, short-term cash instruments to make sure you have a reserve should you need it immediately, and then sliding out that income spectrum, both fixed income investments as well as companies that pay dividends, and more importantly, have the likelihood of raising those dividends in excess of the rate of inflation over time. So your purchasing power increases over time. And then certainly up toward the growth corner, a factor that's likely to outpace inflation in terms of company growth and appreciation. So it's a situation that we encounter almost daily at Albion with our clients in terms of discussions, and how do we think through what that allocation would be. And the investment team that Jason leads has, if you will, has built sleeves to meet each of those specific the specific attributes of the portfolio that will both give us the safety piece, give us the income that's likely to grow faster than inflation, give us core income, as well as add a growth sleeve that makes sure that overall the portfolio has a high probability of beating inflation over those retirement years. I'm going to now kick it back to you guys after I took a shot at it and see if you have anything to add to that.
My big thing is that we do not base asset allocation on what is going on in the market. It is based on what is happening in your life. And the reasoning behind that is, like John said, it's so dependent on the person, and it should not be dependent on, okay, the market's up right now, the market's down right now. We should be chasing what's happening, because that's a losing battle. If you have a long time horizon, you should be invested long term. But if you don't have the stomach for the market to be going up and down, then we need to figure out an asset allocation that keeps you invested, because that's what's going to make you successful. And so you'll hear that a lot, that we're not going to change. We're not all of a sudden going to make your accounts very, very conservative, because we had a recessionary call last year. We weren't saying, but we were not all of a sudden saying, okay, we're going to put your entire account in treasury bonds. We're staying the course. We're going to stay with your current asset allocation. Now, what's going to change your asset allocation is, you're retiring, or you lose a job, or other things happen, or you have all of a sudden new income needs. That's when your asset allocation is going to change, because your life has changed.
Yeah, I would just add, agree with everything you guys have said. And kind of as we think about asset allocation, at the end of the day, it's driven by three things. That's goals, time horizon, and risk profile. And risk profile can be very dynamic. And the next layer down is portfolio composition. And that's really, where the investment team comes in and brings our research and our knowledge and our experience to bear in building quality portfolios and service to the asset allocation. And that composition is, what do we want to own? What are the opportunities in the market? Thinking and acting long term, of course, wanting to own the secular growth winners over the next 10 years. When we buy a company, when we buy a stock, when we make an investment, our holding period is very long term. Now, it doesn't always work out that way. Things change, and if valuation changes or the fundamentals of the business change, we make changes in the portfolio. But ideally, the design of the composition of the portfolio is to have a high bar of change, because we're owning quality businesses, we're owning quality companies. And I talked a little bit about this in the quarterly letter that just went out. I hope many of you have had a chance to read that. But it's like, as you work your way down the spectrum from asset allocation to portfolio composition to kind of how things are going at the macro level, and that's what Danny's talking about. We're not going to make changes at the asset allocation level based on the macro, but we will turn the dials on the portfolio when we see risks building in the economy. And that's not going to be major wholesale changes. Those are going to be incremental changes in the portfolio. Most recently, as Danny mentioned, we've been on recession watch for some time, 18-ish months. And we turned the dials on the equity composition to put a little bit more of a defensive tilt in there. We kept those great companies, those long-term strategic assets in the portfolio. We're still very bullish on. We're not going to sell, Alphabet or Amazon or Apple because we think the economy is hitting a slow patch. That's not how we manage money, but we do turn the dials based on the macro to add some defense and to remove beta, as you've heard us describe. So as you work your way down those tiers, asset allocation, portfolio composition, and kind of rolling that in with our macro view, as you work your way down, activity goes up. But activity is pretty limited because, again, we're very long-term oriented at Albion. So that's kind of how we think about it as well. And that asset allocation is very static based on you as an individual.
And there is a lot of thought behind it. Sometimes I feel like in the conversations that we have with clients, it kind of feels like we just throw numbers at you, like, okay, how about a 60-40 allocation? There is a lot of thought that goes behind it, and some math that goes behind it. And just to let you behind the veil a little, like what kind of goes into it, especially retirement, is, okay, what are your income needs? So I need $40,000 from my account each year. Okay, what kind of withdrawal rate is that from your accounts? Is that sustainable? Okay, then I talk to the investment team. How much can we safely generate in income from the account? How much is income versus principal within the account? How should we invest it over this time, this expected time horizon, that they won't run, as clients will not run out of money? And then what is, besides taking care of you, what is your secondary goal? do you want this money to pass on to future generations? And if that is a secondary goal, then that plays into the asset allocation as well. So there's a lot of pieces that go into it that maybe we ask you a lot of questions to get to the asset allocation, but we may not explain exactly how we got to the answer all the time, because it's probably kind of boring.
I don't think it's boring, Danny. I think it's fascinating. I find it very interesting. Well, that's the end of the questions that we had intended to answer. And I don't see any other questions that have come in from any of you who are attending. So rather than, yeah, we haven't had any come in. I just had something flash on my screen about NVIDIA, but I think Jason already addressed that, the concentration in the markets right now, where a handful of companies have really generated a lot of the return. So rather than drag on and hear us chat about nothing in particular, we'll give you 6 minutes back and end in 54 minutes instead of an hour. And thank you all for attending this. Please know that our final conference call of the year will be in mid-November. We haven't nailed down the date specifically nor the time, but just be looking out for that. We will let you know. But thanks for attending and have a great evening.